Imagine trying to, empty a swimming pool with a teacup while a fire hose is just running full blast. That is essentially what the U.S. Treasury is doing right now.
Yeah, it really is.
We're looking at a pretty staggering macro reality today. I mean, we've got a $40 trillion U.S. national debt, and it's costing us, what, $3.8 billion a day just in interest.
Right. It's wild.
So for this deep dive, we're tracking exactly how this escalating sovereign debt is colliding with global friction and how that pressure is actively stress testing the Bitcoin ecosystem today. Because the Treasury is currently issuing $10 billion in net new debt every single day. And meanwhile, Treasury Secretary Bessent is deploying, $4 billion a session in bond buybacks to try and manage borrowing costs. So that's the teacup against the fire hose.
Exactly. And that relentless fire hose of new debt is exactly why the bond market has essentially rejected the Treasury's intervention. I mean, the 30-year Treasury yield just spiked to 5.24%. When you see yields climb like that, despite the government actively buying bonds, it means investors are demanding higher returns.
Because they see the underlying risk growing.
Right. Stanley Druckenmiller actually pointed this out in his Wall Street Journal critique. He called the buyback program an artificial price control.
Mm-hmm.
The market is basically saying, you can't engineer your way out of this much supply.
Yeah, and this domestic debt issue, it isn't happening in a vacuum either. It's colliding head-on with global supply chain shocks. We just saw that projectile strike disable an oil tanker in the Strait of Hormuz.
Yes, that was significant.
Right. And in response, Bessent announced new secondary sanctions on Iran. And notably, these formally include digital assets. But wait, hold on, I have to push back here.
Okay, sure.
If the U.S. is actively sanctioning crypto transactions, wouldn't that just destroy Bitcoin's liquidity? Doesn't that thrust it directly into the geopolitical crosshairs and make it incredibly dangerous to hold?
Right. You would think so. On the surface, yeah. But the underlying mechanics actually do the exact opposite. Deploying sanctions this way inadvertently highlights Bitcoin's core utility.
How so?
Well, think about how the network actually functions. It's a neutral settlement layer, completely devoid of sovereign risk. I mean, no government can freeze a wallet on the base chain.
Right.
So when traditional financial rails are weaponized or restricted during a geopolitical crisis, global capital immediately seeks safe harbor.
Oh, I see.
That's why parallel assets like Bitcoin and physical gold inevitably see a price increase during these friction events. The sanctions don't restrict the network. They just prove why a permissionless network is necessary in the first place.
That makes a lot of sense. If you're a nation state or a massive fund, that flight to a neutral reserve is exactly what gives you the confidence to step in.
Exactly.
And that perfectly explains the sheer weight of institutional capital we're seeing anchor today's price. I mean, just look at the ETF inflows on Monday alone, $337.6 billion.
Yeah, massive volume.
Right, and that kind of volume established a huge concrete floor above 77,800, and it's why the asset is currently stabilizing right around 79,100.
And that institutional confidence isn't just coming from ETF mechanics, it's coming from regulatory signaling too. Wall Street needs validation from the people managing fiat.
Right.
That brings us to Federal Reserve Governor Kevin Warsh and his upcoming Jackson Hole address. He makes a crucial, very deliberate distinction.
Which is?
He is categorizing Bitcoin strictly as digital gold, meaning he'd use it as an objective, neutral gauge for central bank policy.
Wow, okay.
Yeah. And at the same time, he separates it entirely from speculative crypto tokens that lack monetary properties. When a Fed governor frames it as a legitimate macro indicator, institutions listen.
So the spot market and the regulators are validating the asset. But here's the disconnect that I'm struggling with.
Okay.
While Wall Street buys up the available supply, the infrastructure layer, the companies actually maintaining the network, is telling a wildly different story.
Oh, yeah, the miners.
Right. It's kind of like selling shovels in a gold rush, but the shovel makers are drowning in debt. Look at a miner like CleanSpark. They currently have a 234.7% debt-to-equity ratio, and that's despite Bitcoin itself seeing a 21% gain over the last week. Why is the infrastructure lagging so far behind the asset?
It comes down to the physical vulnerability of the mining business. They have massive capital expenditures, high leverage, and most importantly, operational jurisdiction risk.
Right.
When you have highly leveraged balance sheets, one disruption can wipe you out. Consider the sovereign contract risks we just saw in Uruguay.
Oh, yeah, the Tether site.
Exactly. The state power company there abruptly cut electricity to Tether's $120 million mining site over a contract dispute. When you rely on a nation-state's grid, you're at their mercy.
Right, you're physically anchored to them.
Right. Contrast that physical vulnerability with the safety of Texas, where companies like Saluna and Bitdeer are actively mitigating risk through a 28-megawatt co-mining agreement. They're sharing the infrastructure costs and leaning on a stable grid.
The contrast is even sharper when you compare those struggling, highly leveraged miners to the corporate treasuries that are just hoarding the asset.
Oh, absolutely.
You have a company like Metaplanet casually shuffling 1,000 Bitcoin within their 3.4 billion corporate reserve.
Yeah.
They aren't spending capital on mining rigs or fighting over power contracts. They're just systematically locking up the supply. And you combine that with off-exchange protocols like Athena, which act as giant vaults, taking even more Bitcoin out of active circulation.
Exactly. The actual liquid supply of Bitcoin is being locked away by corporate treasuries and institutional vaults precisely as that U.S. debt issuance floods the traditional market.
Which brings us right back to our original macro problem. If you're wondering why traditional portfolios might be feeling the strain right now, the underlying math of the U.S. Treasury is just relentless.
It really is.
They are forced to issue that $10 billion in net new debt every single day just to fund the deficit. So here's a thought to leave you with. With that teacup bailing water while the fire hose of government bond surplus runs on full blast, how long until the sheer volume of that sovereign debt permanently breaks traditional portfolio models and forces a mass institutional rotation entirely into digitally scarce assets?